Moderate today's panel is Kelly Dickerson, principal at QED Investors. Some of you might remember Kelly from moderating a compliance panel at Contact.io, which was a great discussion, and we know we're in store for the same today. So with that, I'll turn it over to Kelly and the panelists.
So it's kind of interesting. You march on here like the military. I just got off a military weekend flying around a helicopter, and I'm like, wow, it's like marching on the military again. Hey, well, good afternoon. Just after lunch, we're going to try to prevent that food coma that usually sets in by now. So folks, please come up front. I hope that this could be a conversation, not just a couple of us talking about regulatory environment compliance in the marketplace lending. So I think many of you have come here to kind of discuss some things of topics that are kind of near and dear to your hearts. I'm sure there's mostly compliance folks, regulatory folks, legal folks, some operators in the room. So I want to get started by just introducing the panel. Jesse Silverman, Chief Regulatory Counsel at LendUp. Corey Camphor, who just won that great award. He didn't tell us he won the award, so drinks on you tonight. Yeah. Chief Legal Officer at OnDeck. And Manny Alvarez, General Counsel and Chief Compliance Officer at Affirm. As Paul said, I'm Kelly Dickerson from QED Investors. We invest in fintech, insurance tech, and some ad tech companies. And I, as an operator with the company, help our companies grow through proper scale, compliance techniques, and also just making sure they're managed growth. So I want just each of you to kind of give us a little background of where you came from and what you do at your current firm.
Starting with me?
Sure, why not?
Excellent. Jesse Silverman, Regulatory Counsel for LendUp. Before this, I was actually with Manny at the CFPB, that rogue agency. I could see some of my former colleagues over there as well, making sure that I don't say anything untoward. Now I'm at LendUp. We are an alternative lender, alternative small dollar lender, social driven as everything else in Silicon Valley is, and really a market driven solution to all of the problems in this small dollar market, as well as credit cards.
I'm Corey Camphor. I'm the Chief Legal Officer of OnDeck. I joined OnDeck in 2011. Prior to OnDeck, I was at Paul Weiss law firm here in the city. OnDeck is an online provider of small business loans. We've loaned over $4 billion since our first loan was made in 2007. We're strictly focused on small businesses and have loaned to over 50,000 different small businesses across the US, Canada, and now Australia.
Manny Alvarez, General Counsel, Chief Compliance Officer at Affirm, where I've been for the last 2 years. Previously spent a few years at CFPB, was also in the Consumer Protection Unit of the California AG's office. And I can't believe I'm now on this side of the table. So Affirm seeks to build honest consumer financial products and services that help empower customers make better decisions about their finances. Our core product right now is a point-of-sale installment loan with flexible terms that customers can choose for themselves. We are looking at new products and features to help us develop more of a daily dialogue with our customers, again, so that we can continue to help our customers make better decisions about their finances.
So as a follow-up, many would say, hey, this is a new space, but with the billions of dollars and tens of thousands of customers that we've already lent to, it seems like the marketplace or ecosystem is getting kind of crowded. So what things are you guys doing that differentiate you from your competitors? Start with Manny.
Sure. I think at a very high level, we focus on the customer experience, both at a product level and also at a customer service level. From the product level, all of the design decisions that we make, we try to make them with an eye toward minimizing the need for fine print. Obviously, given the regulatory compliance regimes that we operate under, it's impossible to do away with all fine print, just because a lot of disclosures are mandated. But we believe that if wall of text is not really helpful to customers, And so we think that there are a lot of design decisions that can be made at the product level, so that you build that relationship with your customer and align your interests with your customer's interests.
Great. Corey?
Yeah, we definitely focus a lot on making a very simple, user-friendly process for our borrowers who are small business owners, and largely their day is extremely busy managing their shops. So having an online experience where you can fill out the application after work or over the weekend when it's convenient to you definitely is a big plus versus visiting a bank branch. Another, I suppose, innovative change with our business is we're partnering more and more with large financial institutions like JP Morgan Chase to leverage what we do really well, which is the underwriting, the credit IP, and that user experience with the assets that they bring to the table. And I think that can be very powerful.
So we at LendUp, we were starting with a very broken market. The payday lending market, the small dollar market, it's just fundamentally broken, is fundamentally broken. So to say how we differentiate ourselves is pretty much everything that the traditional market does, we do the exact opposite. The biggest problem with the payday industry today is that small dollar lenders, they are incredibly sticky. If I'm a borrower, I go in there, I get a very bad rate because I have either no credit or I have distressed credit. I've got a 300 FICO score. No one in the traditional banking system will lend to me. But we also have to remember that we're not talking about just these other people. Those people that we're talking about, we're talking roughly, 52% of America would fall into that category, that distressed borrower category. So this isn't a small problem that affects just a handful of people. But the problem is you go into that traditional lender, you go there, you take out your loan, and you pay it back on time, and guess what? That's great. You go back again, you take out another loan, you're going to pay the exact same rate. You're going to pay it off on time, and everything's great. You go back again, guess what? You've got the exact same rate. Nothing ever changes. There is no way out. And people who focus, you probably heard about rollovers and the debt traps. All of those are gone with us. But the big difference, I would say, for us is, so you start there at that, that single payment loan with the high interest rate, all the things that we don't like. The difference being, once you demonstrate that ability to repay, you're not stuck there. So you move up. And then the loans and the rates that you're going to get are longer terms, lower rates, and then it goes on and on and on all the way up to the top till we're sub 36% rates. And now that we actually issue a credit card, we have a credit card which, if you pay on time every month, you will pay 0 rates. Very traditional subprime credit card. So the difference between us and the other lenders is we have the value to the consumer that I see is you can move up. So you're not stuck here, you are moving up. And we've now effectively taken actual subprime consumers from that first single payment loan with the not awesome APR and taken them all the way up to the credit card. So they have, we have, for a long time, we were in, I guess I would say, concept phase. We're now past that. We're in proof of concept phase. We have taken actual borrowers from here and brought them up here. And that's something that it doesn't exist anywhere else in the market. Nowhere.
So I'm going to take that, Jesse.
Yes.
We're going to mix it up a little bit here, and this is where I hope we get some audience participation. Let's just kind of rip things from the headlines. So you talked about payday lenders. So first I want to start off with one of the larger players in our ecosystem has been under some regulatory stress recently in the regulatory review. And additionally, Google announced that they're going to ban payday lenders, those that have high interest rates and short-term repayments, from advertising.
Yeah.
So I'd like folks, and it impacts differently from a consumer versus small business, but if each of you, starting with Jesse, just kind of, what does that mean to you?
Well, it's fascinating on a number of levels, most notably because Google, through their ventures, is an investor in us, and that has certainly made for some interesting media. But it really is fascinating because Google clearly is trying to take a step from a policy perspective on regulating what is a very, very challenging and distressed market, that payday lending space. And so what they've essentially done is they've said, we're no longer going to allow paid advertising for loans which meet this certain criteria, which is basically anything over 36%, and then anything that has a shorter duration than X. So remember, that's just banning it from their paid space. It's still going to be available to be found in the natural search. Parenthetically, I think we love it because we do fantastic with the natural search, and obviously we would love to not have to pay to obtain consumers. So parenthetically, I think that it's going to be a net benefit to us, but it is a very fascinating place for Google to be because and I don't think it's necessarily the first time they've done this. They've done this, if I remember, with tobacco products, where you have an otherwise legal product that they are notwithstanding going to bar the advertising. I suspect it's going to be very challenging for Google to effectively police their restrictions. I think that I think that this will be an even more interesting conversation as we sit here next year if we see whether they can really effectively police that issue. If they can, I think frankly, it's fantastic. It's going to impact some portion of our product, that product down there. But given how bad the marketplace has been, we're willing to live with that. I mean, like I said, we have products that range from here to here. So it's not going to be, I believe, a material impact. There will be a material impact for tribal lenders who don't necessarily comply with the law. I apologize if there's any tribal lenders in the audience. Offshore lenders, you guys are probably not here because you're in the Cayman Islands like I would be if I worked at an offshore lender. But I think if it effectively blocks them, I think it is a net positive.
So Manny, what about some of the issues one of our brethren are facing today? How do you look at things? How does that impact you?
Well, a couple of things to note. I think as a practical matter, it impacts our company. It impacts Affirm because it applies some pressure on our capital sources, and that's really the most immediate effect it has on us. Any kind of headline momentum is going to tend to spook our capital sources, and that just makes our conversations harder to have, and it requires us to prove out our compliance processes. I don't know if we're purposely avoiding naming one of the headlines in particular.
Sure, no.
So
Some small multi-billion-dollar lending club type of thing, yeah.
The lending club issue, I know nothing more than what folks have read in the media, but it seems to me that at one level you might say, this is actually an example of compliance processes working correctly. It's probably of little solace to the board and their investors and the stock price. But the fact remains, the issues seem to be they were surfaced through a series of compliance protocols.
Exactly.
It will pose some challenges to us for the reasons I said. So, I think there's really the best that we can do is continue investing in our own compliance infrastructure and trying to stay above the fray.
And I think why I bring it up is because it's not bad to talk about those things. It's really part of us as a marketplace lending community to have those conversations collectively, say what can we do better, what are we doing, do we have the predictive and preventive controls in place, and how do they work? What is our how do we compare against our financial institution folks out there that we're trying to compete against, but also partner with at the same time, as Corey has said. Corey, how about from a small business perspective, not so much consumer, but on the small business side?
Yeah, so on the small business side, the news from Lending Club obviously brought some more scrutiny to our space. But one of the mottos that our legal and compliance team has always had is to skate to where the puck will be. And whether that's working with Perform Line on things or forming a trade association that we recently did with Can Capital and Cabbage to provide borrowers with really what we could describe as an apples-to-apples comparison in a smart box that shows a variety of different pricing metrics that they can compare loans to each other. We spend a lot of time and effort on those initiatives, and it isn't in response necessarily to Lending Club, but it is trying to be ahead of the curve of where we think things will be going.
That makes sense. Anybody from the audience? Any questions, topics to bring up? Just want to make sure. All right, you're going to get there, I promise. So let's kind of shift a little bit there. So from a regulatory perspective, many of the regulators, some in the room here, have been very vocal about the marketplace lending. Does it pose more risk? Are there more consumer or small business concerns in that space, especially from a disparate impact perspective? Or do they have the controls in place? Are they growing too fast? What are their lending practices? Are they excluding certain folks? What are your thoughts on that? I'll start with Corey, just on that from a small business perspective.
Yeah, no, absolutely. So with that, we always encourage the regulators and lawmakers to learn more about the industry because there's so much innovation happening, and it is not at all a one-size-fits-all. You have consumer lenders, commercial lenders, on-balance sheet, off-balance sheet, mortgage. People are getting into the mortgage space. You have student loan lenders, and so really trying to understand the ecosystem we view as step one. And then, we can engage in thoughtful dialogue about promoting industry best practices or, self-regulatory practices that I mentioned just a minute ago with Can Capital and Cabbage to try to, solidify the industry in terms of the way that we govern ourselves. But it all, the foundation of this, we believe, is definitely through the education and understanding how these different platforms work. And at the end of the day, I certainly believe that we're benefiting our borrowers, and that can't be overlooked with any of those discussions.
So Manny, some folks have been out there vocal enough to say that perhaps just as the traditional financial institutions had risks, that some of the marketplace lenders are posing more risk, whether that be regulatory risk or financial risk or even consumer borrower harm risk. What would you say to that?
I don't agree with that statement. I think it's you have to unpack it. I disagree with the notion that marketplace lending creates new consumer protection problems. I think it is true that the new framework will create new issues that that we're going to need to think through. Just because you might have a 1973 FTC rule that has a certain legislative history that before the internet was ever created. So I think there are those sorts of issues that you got to think through. But I'm not convinced that marketplace lending creates new problems. I do think that and I think this is unrealized today, but the promise of scale that's posed by marketplace lending, the promise of reaching so many more individual consumers and small business folks, I do think that the promise of scale will present some issues. Will probably tend to magnify whatever consumer protection issues already existed. On the fair lending piece, I think I agree with Corey that we really need to continue to educate the regulatory agencies and law enforcement agencies that worry about fair lending and disparate impact issues, because it seems to me that it's in direct tension with one of the other trends that we're starting to see, which is a movement toward an adherence to an ability to repay underwriting standard. Which I wholeheartedly agree with. The problem there is, as you hew closer to that, what do you think you're going to see in the way of disparate impact? you're going to see strong correlations between one's ability to repay because it's strongly correlated to wealth in America, and unfortunately in America that is strongly correlated to certain prohibited bases. So I think there are on conversations like that, we need to be able to engage in an honest conversation with regulators and work through that. We can't pretend like that tension doesn't exist.
And Jesse, that must present some unique challenges for you as well, considering the space you're in.
It does, but I think ironically for us, those concerns are probably the exact opposite of Manny's, say. So our concerns are that we are focusing on protected classes. We are targeting protected classes. So I think our concerns are frankly almost in the exact opposite direction, but I completely agree. And it's been interesting and troubling all at the same time to watch the media discussion about marketplace lending, certainly, but also about fintech, because very often the conversation is fintech good or is fintech bad? But I think just by the people on this stage, fintech is so many different things. I would suspect that if you came into our 3 offices, the concerns that a regulator would or should have is absolutely radically different. We have 3 entirely different business models. We're reaching 3 entirely different demographics. We are performing our services in 3 entirely different ways, notwithstanding the fact that the core underpinning is technology. But honestly, that's pretty much the only correlation between us. And it's one thing, I say it's interesting because it's interesting to see the media miss those distinctions and sort of lump people together. And that's just the way life is. It's another thing entirely when you read, say, the OCC's white paper or the Fed's white paper, and they miss many of these distinctions. That to me is slightly more interesting, slightly more troubling, but it also to me highlights the fact that that education process has to happen both ways. There has to be an education process with Silicon Valley and the regulatory concerns, but also vice versa. It's clear to me that many of the regulators don't understand how the businesses operates. And the fact that they would think of the 3 of us as the same thing pretty clearly, indicates that to me, because I'm sure that we have almost no comparisons, like I said, other than the fact that we use the internet. To that extent, we're the same thing as catsdoingyoga.com. We all use the internet.
So let's be fair in that space. So with all this regulatory activity, right? So we've got a lot of regulators looking into it, state AGs, even the media and those pieces. Is that good for us as marketplace lenders? I mean, Corey, what do you think? Is that a good thing? Is it a bad thing? Should I be concerned? I'm an investor in some of the companies up here on stage.
It's the $1 million question, isn't it?
Yeah, right. It's good that people are interested in what we're doing, and I encourage them to the panelists' point, get educated on the very good things that the fintech community can do, and the scale and the reach that it can have to open up capital to many different groups. So the fact that folks are interested, and I think a lot of what we've seen is positive interest, but there are certainly things to be concerned about as well. One thing that I'd say is that the notion that there are not laws that exist that govern this space is just false. There's all these lending laws that would apply to brick and mortar bank, just as you would do it online. Fair lending is a great example. So there's a framework that works, that exists with existing laws. But then there are some gaps and probably some opportunities. We mentioned that it's a 50-state patchwork of different laws in an internet age. Is that really the smartest approach when you have a national product or even a global product? You could think about a framework where there could be some harmonization there that would benefit, we believe, the end borrower.
Manny, how about your perspective on that? You've been on both sides, so you're kind of the trader within. So what do you look at?
Well,
Ouch.
You're part of that band too. I'm sorry.
Absolutely.
So,
Glad
so
you saved it for Manny.
first of all, I assume you're a sophisticated investor and you're negotiating appropriate protections in your deals.
Absolutely.
You
And
know,
I'm even more specific, I'm not doing that. I'm having folks like yourself on me that have to pay them.
yeah, I'm the one battling those back. So, is it a good thing? I don't. I think it creates opportunities for certain companies, and we hope to be one of them. But we hope that increased scrutiny in the short term creates a competitive advantage for companies like ours to really show regulators that we have our customers' best interests in mind. I guess the thing I would say in general terms, not all regulatory or law enforcement agencies are created equally, and so you have to deal with each one on their own merits. And in broad brushstrokes, this is gross generalization, but the federal banking agencies, I believe, tend to have an easier time understanding, our business, for example, and understanding our pain points. And it's just, we have had an easier time talking to them about some of the issues we face on kind of a holistic matter, everything from, cost of access and cost of capital all the way down to kind of the loan level regulatory compliance issues. With state AGs, that seems to be less true. They seem to be a little more narrowly focused on their universe, and you try to, it feels like whenever you try to zoom out with them, they kind of resist that and they want to zoom back in. I don't give a damn about your cost of capital. I'm just, talking about the laws on the books here, sir. So, short-term challenges that I hope companies like ours can use as competitive advantages.
So Jesse, let me throw this one to you then. And how do we work better with those agencies? So how do we have those conversations and educate them and learn ourselves as we go through that process?
If I said the other question was the $1 million question, I want to retract that. This is the $1 million question.
You're well capitalized, aren't you?
Right, right. I'm not good with math either. So I think that there are lots and lots and lots of opportunities. It is, so we are slightly different than other lenders in the space in that we're directly licensed in every one of the states in which we do business. And it's actually fascinating. Manny and I and someone else in the audience, we were giving a speech to the annual meeting of the state regulators. And one of the state regulators asked the question, they were clearly trying to be inflammatory, which I very much enjoyed. But they asked the question, why are these marketplace lenders just trying to circumvent state regulations? And I can still remember describing to those state regulators all of the differences between those state laws, highlighting how nonsensical many of them were and how different the raw application process. You could apply in one state and receive a license to do business in 30 days in California. And just in case someone from these other states are here, I won't mention, but other states it could take a year. You can't effectively run a business with that level of uncertainty. And the questions that some of the states, they want to know not just who the principals are, which makes sense. They want to know the backgrounds of the principals, that makes sense. They want to know the investors' backgrounds. They want the personal financials of the investors, and they want so it gets on, it goes on and on and on. So there are significant opportunities to harmonize those laws across the states, which I suggest would be beneficial for everybody, including the states themselves. And to that end, while they're doing it, I encourage them. I said, you have to recognize that technology is a fantastic opportunity for everybody. It's a great opportunity for the companies. It's a great opportunity for the consumers. They can now go online and they can get answers in minutes, which used to take days, weeks, or months. You simply can't replicate that in the brick and mortar. And the reality is we're never going back to that. So the regulators can either embrace that and say technology is here, and it sounds a little It sounds a little silly to even have to say that today, but as both a former federal regulator and as a former state regulator, I assure you, they still have to be told that technology is here to stay. So I said, rather than fighting this is a massive opportunity. I said, for instance, if you're a state regulator and you wanted to examine our books, right now you take a day, you fly out, you sit in our office, you give us books and records. I said, if you told us what you wanted, we could give you direct 24-hour access at your command on your computer in your office. All that it takes is a conversation. All we have to do is know what it is. What is it that you want? That to me is the biggest disconnect I see between Silicon Valley, and I don't know that I'm qualified to speak on behalf of all of Silicon Valley, but based on my experience, that dialogue that could happen, that could make this process easier for everybody, it's just right there for the taking. All people have to do is take it. All the regulators have to do is be willing to ask for it. Because I know that, again, speaking for us, we'd give them 24-hour on-demand access. They could do it instantly. We wouldn't have to spend all this time dealing with regulatory inquiries, which I think we're currently licensed by 24 states, but because we make calls, the FCC also regulates us, the FTC regulates us, the CFPB regulates us, but because we have a partnership with a bank, we've got derivative supervisory responsibility with the Fed. So we are essentially regulated as a systemically important financial institution, just like Bank of America, all 160 employees of us. So I suspect that we could probably all come up with some better solutions than that.
No passion at all. No.
Right. Well, it was a very fun conversation with the state regulators themselves.
How about other folks, other conversations you've had with your regulators, or even the regulators themselves? What can we do better? What are we doing well with our regulatory bodies and agencies in those discussions? Someone's got to be brave enough to...
You feel free to say it was a friend of yours who had these problems. Yeah, it was a friend. You're just asking for a friend.
Well, we'll continue on the technology front then.
Yeah.
So you mentioned technology. Corey, you mentioned technology as well, and some of the things that differentiate you. What kind of things are we doing? I mean, we're here for a conference form line. But what other things are we doing technology-wise that we believe puts us in a better position? Especially, I'm a reformed banking operations person, and I can tell you where I was. You can take a look. Integrating systems from purchases and different banks and different stuff, and then actually getting partners out that you're trying to integrate with, it just doesn't come together, right? So you wind up having a system of systems, which are so complex, it's hard to have compliance pieces, but what are we doing? We started fresh, we started new. What things are we doing now into the future to help us?
Yeah, well, Performline is a great example of how we utilize technology, but really the whole process at On Deck is technology-driven. Right down to our credit IP, which is taking account of a borrower, a small business's credit background and attributes, which we think actually generates a more fair outcome because there isn't the face-to-face that you might have in a branch where someone might be making certain disallowed judgments. So I don't know that there's a real end to what technology can do. It certainly provides us the ability to decision and fund loans quickly, which is important for small business owners. We have ETA, a trade group, did a study, and a small business owner values their time. I believe the number was $170 an hour. And if you think that the average bank process takes about 24 hours, and at the end of that you are likely will not be approved, you can see the value proposition of a more efficient process. And technology drives that.
Jess, you mentioned technology as well at LendUp.
Yes, we use it.
So that's a good thing.
Yes.
Because we're paying for it. But so what kind of things are you guys doing at LendUp in this space with all those regulatory agencies and the collective AGs that are on you?
Well, I mean, again, I'm not sure that I could go into our spiel about best-in-class technology, which I'm sure that is true. I also suspect everyone here has heard it before. It really is a game changer, and I think about it two ways. So when we were talking about the sort of regulatory burdens, I think Manny mentioned the fact that, it's a pain point here, but hopefully we're going to have a long-term value. I was talking with someone from a credit union the other day, and this person from the credit union was complaining about various regulatory bodies and how it was going to, people were out of control and regulation was out of control. And in the back of my head while I'm having this conversation, all I'm thinking is, if it wasn't for that regulation, those barriers to entry, you guys would have been put out of business a long time ago. Those regulations are both a barrier to entry and obviously some pain points on the inside, but there's so many financial institutions that wouldn't exist if the regulations weren't there to keep them in business. And that to me is the difference between the technology. I think back to a conversation we had with one of our data providers. This is probably 2 months ago now. So for the sake of the story, let's say they give us 100 points of data. So we get 100 points of data. And this data provider says one day, you know what, we've got another great set of 100 points of data. Do you guys want that instead? We think that it's better. We said, absolutely, of course we want it, it's better. So they said, okay, we're now going to send you this new set of data. We said, great, we also want the old set of data. Why are you getting rid of the old set of data? They said, well, we send this information out to every financial institution, but all of the systems, the data processing systems at the financial institutions, they can only accept 100 points of data. We said, well, we can fix that tomorrow. So it may still be going on today. We may be the only financial institution that's receiving all 200 points of data. Now extrapolate that out by 100-fold. And I think back to the larger financial institutions. Obviously, they've got the money to throw at the problem, but it's not just a money problem. These are systemic problems. When you don't own and control your own technology, if I'm at, and I'll pick random Citibank or Wells Fargo or Bank of America, anywhere, if I want to change my data system so that I can now accept 200 points of data, I've got to do an RFP, I've got to get a third-party provider to come in, I've got to get it through the investment fund, the investment committee. It's an impossibility, so it just doesn't happen. It's not something that money just stops. So we exist because the banks, the larger financial institutions, weren't meeting consumer demand for any number of reasons. But because of regulations, they're still there. And they're going to be there for a long time. So it is a fascinating interplay for me, conceptually, to look at the difference between the technology, which you just can't solve with money, and then the regulatory scheme, which obviously you can't solve with money. It's a very interesting situation. It's going to be interesting to watch how it plays out over the next 2 to 5 years.
All right, so before some closing comments, anybody have any questions or comments from the audience? I want to make sure one last time for some brave soul to ask for your friend next door. Anybody? Yep, in the back.
So given a lot of the oversight that's out there, do you think that there'll be a trend towards only being able to be a lender if you are licensed as a bank as opposed to being a derivative of a bank?
That is I'll take that one. I think that's that's the $1 million question. No, it is
Billion.
That's
Trillion.
right. It is very interesting. I honestly don't know what the future is going to hold. It seems the current environment seems untenable. There are so many legal challenges which are occurring across. People here may or may not be familiar with Madden v. Midland. I won't wonk out on that one today. But the feds are also looking at a potential federal license. I have always said if I was in a state legislature right now, the first thing I would be doing is I would be proposing a state non-depository bank charter. I would become South Dakota 2.0. All of these fintech companies would march into my state with all of their money and all of their jobs. So somewhere along there, one of those solutions is going to come. I don't know which one. As soon as you know, will you tell me? Because I want to invest. Yes.
We'll be there as well, just to make sure.
Right.
Hey, so we're running out of time here. Just want to thank our panelists for not only today, but the several conversations we had up front to kind of get to where we are today. I know afterwards we'll be at some of the breaks in this evening. So, and again, for folks in the audience, thank you for being here, and thank you from an investor perspective to continue to generate these businesses that do provide value to consumers in a way that we can do it compliantly from a regulatory perspective, but also reach out those underserved populations out there, in a more efficient manner. So thank you.